Good morning and welcome to the internet's only live daily housing show exclusively on BAM. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss a GDP revision, the latest on jobless claims, and a decline in rent prices. Today is Thursday, June 29th, 2023. I am Byron Lazine, and the hot sheet starts now. Take that, Jerome Powell. The GDP has come in above expectations this morning. First quarter economic growth was actually 2%, up from a 1.3% first reported in a major GDP revision, gross domestic product. So the economy is barreling forward. Obviously, Jerome Powell wants to see an economy in the positives for GDP, but not by much, not by 2%. That means we're actually doing quite well. He wants to see moderate growth to make his job of fighting inflation down to inflation's number of 2% easier. The U.S. economy showed much stronger than expected growth in the first quarter than previously thought, according to a big upward revision by the Commerce Department at 8:30 a.m. Eastern today. It increased 2% at annualized pace for January through the March period, up from the estimate of 1.3%, ahead of the 1.4 Dow Jones consensus forecast. Okay, so just basically blew away all of the expectations on GDP growth. This is the third and final estimate for quarter one GDP, so it's locked in 2%. The growth rate was 2.6% for the fourth quarter. So you've got a Q4 and a quarter one where you've got a really strong economy, right? Quarter two, that spring season, you'd expect it to come in once again in the positives. I don't know. We'll see as this quarter is wrapping up literally tomorrow, last day of quarter two. The upward revision helps undercut widespread expectations that the U.S. is heading toward a recession. You've seen in the last few weeks a lot of these banking execs come out and kind of double down on their expectation for recession. According to a summary from Department's Bureau of Economic Analysis, the change came in large part because both consumer expenditures and exports were stronger than previously thought. So consumer spending, as gauged by personal consumption expenditures, the PCE number that you hear about, rose 4.2%, the highest quarterly pace since the second quarter of 2021. PCE going way up, not great for the fight against inflation, but does show strength in consumer, strength in the U.S. economy. At the same time, exports rose 7.8% after falling 3.7% in the fourth quarter of 22. So there is, though, some good news on inflation. Okay, so you've got all this hot economic data, and then sprinkled in there just to make it a great overall morning, there's some good inflation news. Core PCE prices, they exclude food and energy. Okay, so core PCE rose 4.9%, but that's a downward revision of 0.1 percentage point. The all-time price index increased 3.8%, unchanged from the last estimate. So 4.9%, it was supposed to be 5 on core PCE. That's the most positive number in here for the Fed and for Jerome Powell and the FOMC, which will be meeting, of course, July 25th and July 26th. Federal Reserve policymakers most closely watch that number, core PCE, as an inflation indicator. So that dropping down below expectation of being 5 down to the 1 percentage point to 4.9. Good news sprinkled in there on this GDP report. Though Jerome Powell obviously this week has said multiple times that they will be doing potentially 2 increases. So July and September. Jeremy Knight, what's going on, my brother? Typically from Austin, today from Tampa. And I was just actually texting Jeremy this morning. He'll be doing a little Florida tour. So if you're a Florida agent, maybe reach out to him, show him some love. I think he's looking for a vacation home. So if somebody's got one in the back pocket, not to blow up Jeremy here, on the hot sheet, but what the heck? He can take it. All right. Let's move over uh to jobs, which a report came out this morning as well. On the job front, US jobless claims in for the US jobless claims dropped the most since 2021 in this holiday week. So jobs continue to be strong, continue to buck the trend of what the Fed is looking for during a holiday week at that. By the way, there's a holiday code. It's USA, who would have guessed, for BAMX down below. So you can get in at the lowest price ever using USA on the annual. You get 15% off your BAMX subscription. Just pop in USA. Join me in BAMX for all of our courses, live streams, private community, and all of the daily downloads from the hot sheet. So applications for jobs fell by 26,000 in the week with the Juneteenth holiday. 4-week moving average steadily rising, highest since 2021. U.S. unemployment benefits applications fell by the week by the most since October 21. Initial claims were supposed to come in 26,000 higher than than where they did come in. I've got the chart here for you. This is actually down below if you want to grab that. The 239,000 beats the 4-week average of 257,500. You can see the sharp difference there between the 4-week and this past week. So jobs just continue to be incredibly strong, showing us that the economy overall is just not paying attention to what the Fed wants. So I would expect the Fed to hold firm on what they've said this week and continue to raise rates and make it harder on employers. What's making it harder for the Fed to continue to say inflation is out of control is the consistent theme that I've been talking about here for months, and that rents are down. Realtor.com shows a drop in rents for May with more to come. This is on nowbam.com. Realtor.com has released its May rental report. It shows a 0.5% annual decline in the median asking rent, particularly for 2-bedroom units. The first annual rent decline since Realtor.com started tracking its data in 2020. Western markets are seeing the biggest year-over-year drops in rent, with the South close behind, while rents increase more slowly in the Midwest. Rents in the Northeast are holding steady with increases in densely populated metros like New York and in Boston. Okay, let's take a look at the chart, which I have down below for you. This is the biggest argument I have, that inflation is not as sticky or as bad as the Fed wants us to believe it is. And when you have this lagging data, shelter makes up over a third of inflation get pulled out finally, I believe that inflation is going to drop and drop hard. This data right here supports that. Median rent year over year in the gray line is on a straight downward trend. 2022 median rent up over 1,800. You had over 14 to 16% increases. Now you actually are seeing a decline in the median rent year over year. Okay, so median rent in the red, there you do see that number going up, or really it's down a little bit, but staying a little bit steady. But median rent year over year, you see a straight decline down. For 1-bedroom and 2-bedroom, and for studio, all trending down, way down from their peaks of 14 to 16%. Now all of those, particularly 2-bedroom, under in the negatives. You've got 1-bedroom just about flat at 0% year over year, and then studios about 2% up on the year. This is a theme across the board here, where you've got institutions that were buying single family homes. They've cooled off. Invitation Homes, the largest owner of single family rentals, is no longer on a buying spree. In the first quarter of 23, Invitation Homes sold more single family homes than it bought. So they're getting out of some of the inventory that they've stocked up. If rents are coming down, interest rates are high, and the market, the inventory is still low and the market is still high. It's a great time to offload some of this inventory. They're not buying it because they don't believe rents are going up over the next 12 months. So you see Invitation Homes, the largest owner, is starting to sell more homes right now, and they've almost completely stopped the buying spree. Okay. So there's your update and more evidence that rents are coming down. Danielle Hale, chief economist now for Realtor.com. In May, we saw the first year-over-year decline in rents, a sea change from the double-digit growth that renters contended with in much of 21 and 22. This is yet another sign that rental-driven inflation is likely behind us, even though we may not see this trend in official measures until next year. Okay, so that's what kind of sucks, right? That we may not see this in the official measures until next year, because that's when the Fed will wait to acknowledge it. Instead of acknowledging what Realtor.com is reporting in real time, Apartments.com is reporting in real time, Rent.com, CoStar, Starwood Capital, amongst many others, are reporting rents are dropping and have been dropping. Nope, that's not good enough data. We've got to use a poll where we call people at their homes, and it may not reflect what the Fed is looking at until next year. Although still modest, a decline in rents combined with cooling inflation and a still strong job market, which we just touched on, is definitely welcome news for households. While the nationwide dip in rent is good for some renters, it's worth pointing out that rents across the U.S. are still 24.7% higher than they were in 2019. So still some significant gains, but those gains are not continuing to go up as we've seen them the last couple of years. All right, the top 10 metros here with the biggest annual declines in rental costs would be Las Vegas, Bernardino, California, Riverside, Phoenix, Austin, San Fran, Tampa, Dallas, Sacramento, Charlotte, and Atlanta. Those are the 10 metros with the biggest annual declines in rental costs. The 10 metros with the biggest annual increases in rental costs would be Columbus, St. Louis, Cincinnati, Indianapolis, Louisville, New York, Newark, New Jersey City area, Milwaukee, Detroit, Richmond, and Oklahoma City. Realtor.com has some predictions in here. They do believe that, and this is on nowbam.com if you want the full report, continued drops in median rent, averaging a negative 0.9% annual decline in 2023. Interestingly enough, at 9 a.m. today, CNBC put out a study from Rent Cafe, who created a scoring system using 20 different metrics across 3 categories: cost of living, local economy, and quality of life, to rank how renters may fare in each locale. So cost of living would include cost of living estimates, lease renewal rates, and market competition. Local economy would include local job market indicators like unemployment, job growth rates, and renter income. And then quality of life includes apartment location, school quality, and natural amenities. Okay, so here's, according to Rent Cafe's study, the 10 worst places in the U.S. for renters based off of those 3 categories. Number 1 would be Detroit. Number 2 would be Newark, New Jersey. Maybe just one of the worst places, period. I mean, if you're from Newark, I apologize. I love Newark. Brooklyn, New York, Manhattan, Hartford, Connecticut. So 4 of the top 5 are in the tri-state area, the New York, Connecticut, Jersey, area there. And then you've got Dayton, Ohio, Anaheim, California, Queens, New York, Rochester, New York, and Stockton, California. So New York sitting in 4 of the top 10. You've got Hartford and Newark there. So 6 of the top 10 is the tri-state. You've got 2 from California, Detroit, and Dayton there. The 10 worst places for U.S. renters, according to Rent Cafe's recent survey, as published this morning on CNBC. Love to know in the comments, whether here on the live stream or in the replay, how you feel about your market for rental prices, and is it a good or bad place to be a renter right now? Jody from OKC, 4.6% for Oklahoma City does not surprise her with what she's seeing there, boots on the ground. Thank you, Jody. All right, let's take a look at the 10-year. First look before the show, it had popped and popped pretty hard based off of this strong GDP revision. Investors are like, whoa, uh, Jerome Powell might really start to ratchet things up. And we're seeing that here with a 10-year that is now screaming up over 3.839. Remember the estimations that we discussed here recently on the hot sheet have the 10-year sitting between 3.8 and 3.9. So this is in line with those expectations that we've looked. Savan, as born and raised Ohioan, doesn't surprise me. Dayton is on the list, top 10 for worst places to be a renter in America. That's according to Rent Cafe, not according to me, of course. All right, so we're up 0.126. That's a big jump on the 10-year. If we just look at the one-day chart, I mean, look at that jump right there in the 10-year. That's a straight up jump, and it started at 8:30. That is when the GDP information came out this morning. Okay, 30-year fixed yesterday came in at 6.91. I would not be surprised if we head into this holiday weekend over 7% if that 10-year remains sticky today. We could see a 7% today with that 10-year. There's just no question about it. So there you go. That is your housing hot sheet report for the day. Consider sharing this with somebody who wants a 24-hour look back on housing. And if you want the lowest price ever offered on BAMX, the link is down below. If you're a real estate agent and you're not in BAMX, what are you doing? Use the code USA to get 15% off of the annual. Legacy real estate media companies have been ripping you off for years. That's why our price is so low and our value is so high. If legacy real estate media companies had the content in BAMX on their platform, they'd have to charge you like $100 million based off of what they're charging you now for what they're providing. BAMX is destroying legacy real estate media. Join me in BAMX. Get 15% off the annual by using the code USA. You get all of our courses, all the live streams, the private group, and all of the daily downloads, like the charts I shared here today from the hot sheet each and every day. Broke Agent's going to be providing some templates on there and much, much more. Get in there today for the lowest price ever with the coupon code USA. That's on the annual subscription. Hope everybody has a great Thursday. We'll be back here tomorrow on Friday, where I have a report that I'm going to be digging into deep on migration. And this report might shock you a little bit. So I'll see you back here tomorrow. Until then, have a great day and toodaloo.